Good morning, good afternoon, and good evening, everyone, and welcome to this fifth RICS World Built Environment Forum European Regional Webinar on driving ESG in real estate and construction, a foundation for impact investment. My name is Sander Scheurwater, and I have the pleasure of being your moderator for this webinar. The RICS World Built Environment Forum is a global network of people interested in getting information and discussing on the greatest challenges and opportunities in the built environment. So if you've not already done so, I invite you to visit our website, rics.org/WBEF, and register to join the World Built Environment Forum community. You can also download our WBEF app and follow us through social media. In a minute or so, I will introduce and invite our excellent panel to talk about the importance, challenges, and need for ESG and impact investment to become mainstream and give us some insights on what these terms actually mean. But before I hand the virtual floor to them, I would like to spend a few minutes on setting the scene. I think that what all of us absolutely need to understand is that we are confined by boundaries. We can and absolutely should have any discussion on any topic we want, but we have to acknowledge that when certain boundaries are met or in danger of being exceeded, the main discussion point or measurement will dominate other arguments. We see this now with COVID, where the economic situation and the mental health of many and the limiting of certain freedoms are certainly very important topics I don't want to downplay. But when contamination figures go up to such an extent that our healthcare systems can't cope or are at risk of not being able to cope, all other arguments, all other discussions take second stage. And I think it's the same with economics. For many years, we have measured progress through a few economic indicators, taking into account economic models which focused on growth measured, for example, through national GDP. These models, to put it simplistic, have for a long time been based on the paradigm on the economic paradigm of limited availability of both capital and labor, but unlimited natural resources. At the age of 45, my student days remain a pleasant memory, but are becoming rather distant. That said, I did study economics, and even if I did not pursue a career in this field, I remain fascinated by how we try to capture reality into models, or as can be the case with economics, try to shape reality through models. Some of you may already have heard of Kate Raworth's donut economy, which is currently being applied, or at least looked at, by an increasing number of big cities around the world, such as Amsterdam. When I read the book end of last year, it immediately clicked. One point that she makes is that economics, which in turn drives many policy as well as many business decisions, is based on all theories that fitted another world than the one that we live in today. And think about it. If we think about the most known names, Adam Smith's Wealth of Nations was published in 1776. John Maynard Keynes's General Theory of Employment, Interest and Money is from 1936. Neoliberalism, characterized by free market, deregulation, and open trade, began its rise by the establishment of something called the Mont Pelerin Society in 1947, which includes known economists such as Friedrich Hayek, Milton Friedman, and Karl Popper. There are other examples, of course, including more recent ones. The point here is that whilst these were excellent theories in the time they were created, making sense of their time, and to a certain extent definitely still have their applicability today, the world in 2021 is without a doubt very different than the ones that Smith, Keynes, and Friedman lived in. For starters, think about the world population. In Adam Smith's time, the world population was around 800 million. In Keynes's time, it was around 2 billion. Currently, we're approaching 8 billion, 4 times as much as when Keynes wrote his main book, and UN projections indicate that we could be close to 10 million by 2050, after which it will more or less level off. Looking at the population increasing inequality, and above all climate change, I think it is safe to say that both policies and investment decisions based on old economic models alone may no longer be sufficient. We need to look beyond. And I want to be clear, this is not meant to be any left-wing type of introduction, nor a plea for state control and regulation. Liberalism, capitalism, and the economic theories that have supported growth have increased our living standards for many around the world. Compared to the Middle Ages, I'm sure that all of us on this call live better lives than kings did in the Middle Ages. But I see a parallel with the COVID discussions, and on the one hand, looking at the number of hospitalizations as being more important, ultimately, than economic arguments and mental health figures. We can talk all we want about profit, economic growth, and yields, but if our Earth can no longer sustain our existence, these discussions become null and void. So perhaps it is time to look at different models, taking into account that it is in fact 2021, and models that can help shape our systems in the years ahead. So what you see here on this slide is how Keith Raworth views the economy as a donut. The donut itself, the light green, is where humans develop and prosper. In the inside of the donut, within the social foundation, there are people who are being left behind. And to me, this simply means that all the items that you see there inside of the donut, from equality to education to peace and justice, they're all minimum requirements to live in a just world that develops and prospers. And if those requirements are not met, you will get discontent. You will get the yellow vests, and you will get protests against the COVID measures. On the outside, there is Earth. So there is an ecological ceiling above which we cannot go, or at least not structurally and not for a long time without future consequences. And the consequences are there in ways we already expect and know, such as temperatures rising, but also in other potential effects that we may not yet fully grasp. For example, on the 18th of January, a study was published by the University of California showing that future climate change will cause the tropical rain belt to shift, which could cause, for example, more drought in the southeast of Africa and Central America, and on the other hand, more floodings in, for example, India, parts of the world where the largest population increase will happen in the coming decades. With all this in mind, it makes absolute and unequivocal business sense to look at the world in a different way and build our strategies and business models upon new theories as they develop. So enter ESG and impact investment, which for me is all about looking at the world in a different, broader, and more holistic way. This is, in my opinion, about doing the right thing, but not only for society, but also for your stakeholders, shareholders, and the bottom line of your company in the near future, and possibly even already today. So the purpose of this hour of your time is for you to get a better insight and understanding in what ESG and impact investment are, how they are linked, why it is needed, and what needs to be done to let them become more mainstream. Which brings me to the excellent panel of today, all experts and forward thinkers in ESG and impact investment. So I will now introduce all of them in the order in which they will speak, and I would like to ask them to briefly respond so that we know they are still on the line. So first we start with Tina Payet, FRICS, Chair of the RICS Euro Board. Tina and I have been working together for a while now, which has been to my great pleasure, as she is very forward-thinking and has driven the RICS agenda on, for example, PropTech, the Office of Tomorrow, and sustainability. She'll be the perfect person to start off the panel and look at the bigger picture for the need of and to help drive ESG and impact investment. Welcome, Tina.
Thank you, Sandra, for that great introduction.
Thank you. Second, we have Tanja Volksheimer, a Senior Portfolio Manager Europe of Nuveen Real Estate, a real estate investment company. Focusing on the relevance for pension funds, Tanja will explain to us what impact investment actually is, and we'll touch upon some of the triggers and challenges to advance impact investment, as well as the link with ESG. Welcome, Tanja.
Happy to be here. Thank you, Sander.
Thank you. Third, Sebastiano Ferrante, Head of Germany and Italy at PGIM Real Estate, another global investment management company. Focusing on the relevance for insurance companies, Sebastiano will share his views on impact investment and whether return and impact clash or whether they can correlate. Welcome, Sebastiano.
Hello. Hi, welcome to everyone.
Thank you. And finally, Suzanne Eickermann-Riepe, FRICS, the chair of our German advisory board and a phenomenal driver for ESG, both in Germany and for RICS globally. Suzanne will move the conversation from impact investment to ESG in the built environment, explaining what it means, why it matters, and where the opportunities lie. Welcome, Suzanne.
Hi, Sander. Thank you for having me.
So before I hand over to Tina, a few practicalities for the more than 800 people who registered from over 60 different countries. You will have noticed all your microphones are muted, which is necessary with a webinar of this size. However, we very much welcome questions. So somewhere probably on the right-hand side of your screen, you see a question box where you can type your question. We very much welcome that. Try to keep it short and where possible, indicate who you are directing your question to. Time permitting, we will address them, and if not, we will try to address them post-webinar. At the very end of the webinar, a one-question poll will take place on how you found this webinar and to get your suggestions for future webinars, so please stay on for that. And finally, a summary article and a recording with the slides will be available on our website, rics.org/WBEF by next week, Wednesday. And since you are listening to this, you should all receive information on your inbox when that has happened. So with that said, Tina, over to you. What do we need to make ESG and impact investment happen in the built environment?
Great, thanks, Sander. So I have 10 minutes to set the scene on today's topic, ESG and impact investment. And we'll do so by raising and responding to 10 questions that I asked myself in preparing for this webinar, which look into where are we today and what do we need in order to progress. And I hope that will start the ball rolling for a rich discussion to follow. So the first question, what does investing have to do with ESG in real estate and construction? Investors, be it asset owners, asset managers, developers, institutional investors, are at the top of the food chain when it comes to making or influencing decisions around design, procurement, construction, and ongoing management and maintenance of our building stock. It follows that if we want to implement change quickly, it is the most effective when it comes from the top. To put it simply, the wallet is a powerful means for transforming comprehensive industries, and the real estate and construction industry is no exception to the rule. From the manufacturers of building materials to the designer, from the building contractor all the way through to the smart building management system operator and the demolition teams, the impact of the investment euro or dollar, wherever you're coming from, shapes the needs, the product offering, and thus the market. So why is the built environment so important to ESG and global warming? Buildings are a central part of our daily lives. We spend a large part of our days in them, at home, at work, during our spare time, in its different forms, homes, workplaces, schools, hospitals, libraries, or other public buildings. The built environment is the single largest energy consumer in Europe and one of the largest carbon dioxide emitters. Collectively, buildings and the construction sector in Europe are responsible for 40% of our energy consumption and 36% of our greenhouse gas emissions. Now, globally, that sector represents 39% of greenhouse gas emissions. So this is not a small topic. How are governments and investors addressing these impacts, and what are the challenges? Climate change has come to the forefront during the pandemic as the next global crisis to be urgently combated. Governmental pledges for net zero goals by 2050 now cover the EU, China, Japan, South Korea, and the US. That's about 2/3 of our global economy, about half of the world's emissions, and close to 75% of our fossil fuel export markets. This is a massive shift. Building back better and employing economic recovery funds post-COVID-19 to support the European Green Deal is also top of the agenda. However, questions remain on how these pledges will be met and if global efforts to attain carbon neutrality by 2050 are sufficiently robust to achieve their targets. More and more real estate investors are also taking carbon zero pledges and manifesting a desire to use their investment power to make positive impact on society and environment. However, this is not always easygoing when there is a lack of agreed standards and tools to measure, benchmark, and report on the impacts, even while at the same time the requirement from legislation and public opinion is growing. We'll be hearing more on how investors are tackling this topic from my fellow speakers on the panel. So what's the urgency and what's the timeline we're looking at? According to a couple of artists that set up a climate clock, which was installed in Union Square in New York City for Climate Week, we have 7 years, 103 days, 15 hours, 12 minutes, and 6 seconds. That is the window of time humanity had left for action to counteract climate change when the doomsday clock was revealed on the 19th of September 2020. Today, there's even fewer days, hours, minutes, and seconds left, but that gives you the idea of the urgency that we face. So, is there an exclusive link between energy efficiency and carbon emissions? One thing that comes to light when we take a closer look at the various sustainability labels on the market, such as BREEAM, LEED, HQE, DG&B, or the legislation or the measurement methodology for the built environment, is that CO2 emissions are being measured are almost exclusively related to the building's operational CO2, meaning the CO2 that is coming from the energy consumption during the occupation of the building. This has been the focus of the industry for the last 10 years or more, and it is and will remain an important part of the equation for carbon emissions, but it is not the be-all end-all. So where are the hidden CO2 emissions? And I hope it's quite small, the purple and gray diagrams, but I hope you can see them. There remains a whole universe of embedded emissions, those emissions that stem from the extraction of materials, the manufacturing, the transport, the installation, construction, and assembly of construction materials upstream, meaning before and while the building is being built, leading finally to demolition and disposal of those materials downstream, which are currently not on the radar. Now, if you look at the three pie charts to the right, the ones in purple are the ones that are whole life embodied carbon emissions. And in gray, you have the operational carbon emissions, which are the ones that are getting all the attention. So you can see that there is, in this study undertaken by RICS and Sturgis Carbon, demonstrates that, and that was as early as 2017, that the operational CO2 emissions are only the tip of the iceberg. So what this study clearly demonstrates is that without taking into account the embedded CO2 emissions or the whole life cycle carbon emissions of our buildings, our industry will not be able to achieve those carbon zero goals, which I was just talking about, set by industry or by government edicts. And in addition, I believe that governments and municipalities across Europe will start setting embedded whole life cycle carbon targets for new permits soon, following the lead of countries such as Sweden and Finland, which are already putting these sort of embedded carbon targets into place. So what is RICS doing about supporting the transition to a carbon neutral economy? Well, the RICS is conducting the needed research in the sector. You've seen part of it. Surveys of the industry player, creating coalitions and standards with the goal of creating transparency and confidence to measure, to improve within the built environment sector. Notably, as you can see on the left, we've got the construction measurement with the whole life cycle costing. That's the ICMS, and also the International Building Measurement Standards, IPMS, which have become an integral part of measuring the environmental performance of buildings globally. RICS has long recognized the need for correct measurement to create relevant databases and benchmarking, and leading to reliable reporting and boosting sustainable investing. But beyond the CO2 emissions, we also recognize that what is needed to holistically combat the environmental risks our planet is facing is a changing consumer model, departing from the make, take, waste in favor of the circular economy to drive the way. In this instance, Kate Raworth's donut economy model, as mentioned by Sandra's introduction, is an interesting and leading example. So where do we go next? As chair of RICS Europe, a key focal point in this realm for me is the development of an industry standard for whole life cycle carbon measurement. My vision is to employ this standard within a centrally accessible database of carbon emissions of the building stock in Europe. This database would contain a long list of building components and their means of transport alongside their related carbon emissions, all registered in a sort of carbon passport at building level. This would allow for each material's carbon emissions to be automatically computed and then valued from a financial, ecological, and social standpoint. The passport could then be used, for example, to facilitate trading of recycled, reconditioned building components as a commodity futures exchange on a centralized platform, thus promoting the use of the circular economy in the sector. The carbon database would also provide the industry and its investors with carbon accountability, which in turn will facilitate virtuous green investment, supporting goals to combat climate change through reduction of greenhouse gas emissions. Whether it's the refurbishment of an existing building or a new development, whether we're talking about a single home or a large commercial block, the quantitative information coming from the carbon passport could support the business case for sustainable investment in construction and real estate. I also foresee that under the impetus of growing legislative environment on reduction of carbon emissions, lest your asset becomes carbon stranded, which is a term we've been hearing a lot about, the carbon passport will become an indispensable tool for the responsible investor looking to create and demonstrate the green value of their building stock. This virtuous ecosystem could stimulate the real estate and construction industry in Europe to operate a step change toward the circular economy. So how do we get to that vision within the timelines, which are very short, that we have before us? Our approach at RICS is to drive investments and practices in sustainable buildings, construction, and infrastructure across Europe in three main different ways. First of all, advocacy at the EU level. RICS is carrying out actions in advocacy, notably providing insights and advice to the EU Commission for the development of the EU Green Taxonomy, as well as participating to a coalition of industry players working towards the creation of an EU roadmap for whole life cycle carbon emissions in buildings. We also work in partnership with some of the main industry players, such as working hand in hand with the European Association for Investors in Non-Listed Real Estate Vehicles, INREV, and EPRA, European Public Real Estate, to put forward common recommendations to EU policymakers to shift private capital towards greener alternatives. We've also collaborated with the Ellen MacArthur Foundation in association with Arups Engineering on a groundbreaking study on the circular economy called From Principles to Practices, Realizing the Value of Circular Economy in Real Estate. We're also supporting the World Green Building Council as ambassador to the Building Life campaign. And this is really, really key because 10 European Green Building Councils have put themselves together to deliver the EU Green Deal by tackling the whole life environmental impacts of the building sector. And RICS and myself as ambassador to the Building Life campaign for Europe are working on that with them. And the list goes on. The last question I have for today is, would you like to get involved? Last but not least, we look to solicit our members and the wider industry's involvement, their inputs, their support in moving forward our sustainable initiatives. We're channeling this important work stream through the World Built Environment Forum and its communities. So please sign up if you haven't already done so and watch that space for more to come. This is the time to step up and pave the way to a more inclusive and sustainable built environment. The importance and the ability to leverage our sector's expertise in this realm should not be underestimated. So thank you for listening, and with no further ado, I hand over to my fellow panelist, Tanja Volksheimer at Nuveen.
Thank you, Tina. I really like what you said at the start about the wallet is a powerful means to instigate change. Sentence I will use going forward. As you described, I think a holistic whole life cycle approach combined with consistent measurement to enable consistent reporting and the need to cooperate sound like the three crucial preconditions for both impact investment and ESG in real estate and construction. So indeed, next, Tanja, please tell us about impact investment and what Nuveen is doing.
Yes, thank you, Sander. And hello, everybody from Germany. I'm tremendously happy to be here today to speak to you about impact investing, a topic that has gained prominence in the sustainability movement and that is really coming out of its niche. It's no longer a visionary idea of foundations or social entrepreneurs maybe, but really a differentiated billion-dollar market with growth potential and high dynamics. In other words, it is fair to say that it does not only grow in size, as industry titans are starting to call it their own, but it is also growing in sophistication. By way of background, this slide, why is Nuveen speaking about impact investing? Nuveen is a $1 trillion investment manager. We are the investment manager for TIA, the Teachers Insurance and Annuity Association, which is a large institutional investor with a history of serving teachers, healthcare professionals, and other non-profit workers with retirement and other financial services. So what distinguishes us from other asset managers is that half of the assets that we manage are for our teachers, as we call them in short. And this client base really is the reason why we are so active in investing, impact investing. Early on, they really wanted to know, what exactly are you investing my money in? What is the money doing for us? And wanted this to be value-based, often with a clear benefit for people and the planet. And so we can look back at 5 decades of responsible investing and 30 years of impact investing. We now have over $6 billion of impact investments for TIA, $6 billion. That is $5.1 billion across public fixed income and $1.1 billion across private equity. This ranges from blue bonds that invest in sustainable fishery, for example, to themes contributing to inclusive growth and investments in companies that address climate change or food or waste, to affordable housing. And I will show you an example in a minute. Speaking for Europe, Nuveen Real Estate is now specifically looking at European strategies in affordable housing for Germany, for example, and urban regeneration in the UK, just to name these few. Let's bring this to life now. We have a few examples out of our 10-year report. The aim is transformational change in impact investment. Next slide, please. Avishka Group is an inclusive growth example where we invested in a company that drives positive change by investing in entrepreneurs who aim to improve lives in underserved communities. Impact is at the core of the business. You would say that's interesting, but it's not real estate yet. The middle example, and I hope you can see the next slide because my computer is not as fast, I guess, is a company that builds an innovative new glass that changes its tint to let in the right amount of natural light. And this in turn increases occupants' comfort and productivity and significantly improves cooling and lighting efficiency with 25% savings on average on building energy costs. Thank you. That is real estate related. Yes, that was the middle example. But the real estate example I brought you today is Shore Hill Senior Community on the right. In impact investing, you always ask yourself, what is the challenge and what do you provide a solution for? So how do you want to do that? Who do you want to do that for? And this is the challenge in this particular case. 1 in 4 households in the United States does not have access to affordable housing. So building new affordable housing or preserving affordable housing is clearly an impact. Often, even seniors who can afford rent in the cities have little money left for other essentials, such as food, maybe, or medical care. In this example, we are in Brooklyn, where the rent prices are among the highest in the US. 666 seniors live in this affordable senior housing community located in the Bay Ridge area. Tenants here do not pay more than 30% of their income in rent, which is a healthy ratio. This is price controlled and, as a consequence, 45% below market, which is huge. This restriction on pricing is due to run out, and project developers are already dreaming of making this into a luxury residential complex, just to be a little bit pushing it at the moment. So this is not going to happen. My colleagues moved in, bought the property, and will seek to renew the affordability restrictions for the seniors. And this is only one aspect of the impact. Built in 1977 and renovated in 2008, there's of course room for Shore Hill to have some energy retrofits, lighting upgrades, that will also reduce the so-called second rent, so the service charges. So we have 21% less water use and at least 11% less energy use. And best of all, and in this particular case, there was a teaming up with a foundation. We have amenities for the seniors, community rooms, dining rooms, and so forth, and tenants can take advantage of classes, crafts, and activities. Shuttles provide easy connections to transit hubs and shopping. We have to remember that with real estate, we're building urban spaces where people can thrive. So naturally, we should be looking at what we are building them for, the people that are inside. One of the biggest challenges at the moment is the right definition of impact investing. Important to note, all properties have an impact, but not every investment is an impact investment. That is a very crucial phrase. Impact investing goes beyond traditional and responsible or sustainable investing. The minimum investment style that we know here on the left are exclusions. Our assets do not have a gambling hall, or we are not letting anything to a fossil fuel tenant. And then there's ESG screening to balance risk, return, and opportunities and to mitigate volatility. And ESG integration, possibly even thematic funds like green building. And then finally, impact investing. In addition to the financial return, it also generates benefits and added value. They can be, and we think they must be, mutually coexisting: financial performance and environmental and social performance. What might be a bit misleading is the impact investment discussion, and that people think it is not ESG, but it is ESG too. Like speaking for ourselves, we have 100% ESG integration across all assets, and it goes hand in hand with impact as part of the investment process. Important to note, though, that it is not philanthropy, which you can see on the right. It absolutely has to be compelling from a financial standpoint. We want to contribute to solutions. We want to focus on tangible results for people and the planet. It is a distinct investment style. Terms are overlapping and complementary. So let's look at key criteria in impact investing to dive a bit deeper. For us, impact investing is defined by the GIN, the Global Impact Investing Network, with additionality, intentionality, and measurability at its core. Intentionality. The intended outcome must be part of the investment strategy. You can do that by setting up a so-called theory of change that explains how you want to work and manage towards impact. It depicts the necessary steps you need to take to drive that change and the consequences of those steps. Additionality. This outcome, this impact would not have occurred without the investment. Building social housing because it's an area depicted by the government where you can only build social housing is not impact. Building materially amounts more of social housing, although it is not called for, that could be impact. Just to give an example. And the last one, measurability, the topic of the impact industry at the moment. If we are speaking about a transformational change as the main purpose, then you should be able to compare the before and after. And you do that continuously during your management, and you work and manage towards your goal. Urban spaces. Lose the sector thinking. Think urban spaces. If you want to make a meaningful contribution to people, you have to start where they live, where they work. The built environment shapes people's lives like no other sector. COVID showed it really bluntly. Sorry, we have to bring COVID up again. But we have a feeling for a little microcosmos. We have a feeling for our own neighborhood, the district we live in, and it shows us how interconnected we are, and most of all, how interdependent we are. Real estate can thrive when everyone is doing well. It interacts with community, with infrastructure, and good real estate, we believe, can give back to society. So if we had to bucket it up, we would be looking at 4 important challenges and how it goes together with real estate. Issues relating to health and well-being. In 2030, and that's a challenge, 30% of the population will be 75 years and older. So more efficient and more accessible healthcare leads to better health and increases the quality of life, especially for older populations. Property owners can but also play a role in promoting social inclusion by investing in underserved communities, underserved areas, or focusing on buildings that meet the real needs of the community. This could also include affordable housing. The third pillar, we would say, is called enterprising, urban regeneration, something that is especially important after COVID. Employment can be boosted and basic services could be provided. And also linked to that, access to education. Personally, I think education can improve the general health and life expectancy of a society, make the economy grow, and help break the vicious circle of poverty. And last but not least, the prime topic. According to the UN, and starting with the challenge again, more than half of the world's population now live in cities. I think that's also true with COVID, and this figure is expected to rise to 70% by 2050. But urbanization has a considerable carbon footprint, so one of the most urgent challenges we face is to ensure that the cities of the future are sustainable. And last comment on urban spaces, impact investing is always a local solution. So it is necessary to see each challenge in its respective context so that urban areas can develop in which people can really thrive. I hope this was a useful introduction to the topic, and I will stop here, conscious of time.
Thank you, Tanja. I found it very interesting how you put ESG screening and integration under mainstream investment with a focus on the financial return and impact investment to include the environmental and social impact. To me, this actually links perfectly with what I said about the donut economy, where the social impact should address the inside of the donut, the social foundation, and the environmental impact, the outside of the donut, or the ecological ceiling. And of course, following on from Tina, I also noted the mention of measurement and the purpose that it serves, namely to maximize and optimize impact. So thank you very much for your contribution. Next, Sebastiano, can you please share with us how you see impact investment and the role that PGIM is playing?
Yes, hello to everyone. I hope you can all hear me well. Yeah, thanks for being able to join the panel discussion and give you a little bit of introduction about what PGIM is doing on the impact investing side. And one of the main challenges within impact investing definition, which is the challenge between what is the right return for impact investing funds or assets or deals that you do. As we all know that we still live in a capitalistic world, which is mainly driven by financial data and financial returns still today. We have to embed as well impact investing into this world, right? And not only because of the discussion, what's the sustainable economy going forward, but simply because of one simple fact, which I try to remind everyone. Every investing in the world, which are done by institutional investors, and we have just heard a very good explanation for that, serves a purpose. Yeah? Typically securing the pension of teachers or securing the pensions of firemen or policemen or pension of any other one. So that's exactly what we are doing. The majority of our investors are institutional investors, and they all expect a financial return. Yeah? You don't want to go back to a pensionist of your scheme and saying, look, I couldn't pay your pension because we did a lot of good things, but we didn't manage to get any return out of it. So just this little bit to set the scene of what I'm trying to focus. And just to give a little bit of a background to our company, and then I go into the slides regarding impact investing. So if I can ask to go to the next slide. So PGIM, we are a 100% subsidiary of Prudential Financial, one of the largest insurance groups of the United States. We manage in total more than $1.4 trillion US. So that makes us one of the top 10 asset managers worldwide. And within real estate, of which I want to focus, we currently manage 182.5 billion, which makes us one of the top 3 investment managers. The numbers always change a little bit, but we are one of the top 3. So I think you will get a good impression of where the industry stands by understanding a little bit our approach. So if I ask to go for the next slide. Here again, and I try to be brief, you can see that we are really globally present. And I think one thing that I want to point out, which I think is important, more than 80% of the assets we manage, of the equity we manage in real estate, are coming from third-party investors. So we are really a third-party manager, and we have more than 600 institutional investors in different funds. And the majority, I think over 60%, are really pension schemes worldwide. So going to the next slide, please. You can see our product architecture that goes from large open-ended funds to closed-ended funds and customized investment strategies. And within one of those customized investment strategies is as well our first impact investing fund, which we raised in the US. Which, interesting enough, or maybe if you know a little bit of background, you can understand that it's not surprising that the first impact investing funds, just like for Nuveen, have been raised in the US. The reason for that is pretty simple in a way. It's coming from a definition or a concept, a public concept, who has to take care about social impact, social responsibility, and the role the state plays within that. And that's very different between the United States and continental Europe. And in that sense, it's not surprising that we see a lot of private initiatives from companies like us or Novin in that field, while continental Europe is lagging in that sense. And it has to do with that. One of the reasons is that the state and state-supported companies and institutions are basically filling this gap, which is a good thing in a way. In many ways, don't get me wrong, but it introduces as well some challenges if you want to implement those strategies in continental Europe. So now digging a little bit deeper into it and going to the next slide, and we'll pass on directly to the next one, please. So let's start here, risk and return. Yeah, I think you all know this slide very well. If you're doing investments into real estate, it's a classical definition between core plus, and value add investments, and the return targets that those kind of investment styles, which are linked to the risk, are targeting. And now the interesting question is, where does impact investing sit? Yeah, if you look at return and risk matrix, you're wondering, where is it? Classically speaking, the return targets are linked to the risk. So the higher the risk, the higher is the return. And here, target. And here is one of the difficult points about impact investing, because typically speaking, impact investing includes investing into sub-markets, local markets, neighborhoods, or asset classes which have a higher risk, because a lower income, lower social status, higher rate of criminality, and other aspects which might come along. So you would expect a higher return. But on the other side, I think we have to be, don't fool ourselves and be transparent and fair to the point that it's going to be tough to meet double-digit returns while you're trying to do a positive impact, especially on affordability aspects. Because typically you will not get the investment for free. Yeah, there's a cost to it. So going on to the next slide, and these are the challenges. Yeah, impact investing criteria typically include weak income structures, high rate of unemployment, neighborhood with difficult social environment, low educational density, and a very limited infrastructure. So as I always make the point, if you're looking into Germany, the market where I'm responsible for, it's very different if you want to do an investment in Munich or you're going into the Ruhrgebiet, which is currently one of the most challenging micro markets in Germany. And everyone that invests into a weak sub-market wants to have a higher return. On the other side, we want to guarantee that whatever we build has a positive impact. And if we look at affordability, the rental levels needs to be limited, yeah, to that. So how do you make it work? So the next slide is showing you, and Tanya already explained it to a certain degree, how we try to make it fit within the world of fund time definitions. Yeah? And the important thing is impact investing cannot be philanthropic. One of the very simple reasons is there's just not enough philanthropic funds available to really make a difference. Philanthropic has other issues as well, right? It's very much linked to the personal goals of the one that is investing there, yeah. And it doesn't imply that the money will come everywhere where it's needed. And on the other side, we have the traditional investing, which is purely determined by returns. So in order to make this work, and as well work for institutional investors worldwide, we have to combine both of them. And ultimately, we have to show one, the financial returns, because without financial returns, institutional investors just cannot invest. Yeah? It's outside of their mandate. And on the other side, we have to make the impact, and I think Tanya explained that very well, measurable. Yeah? It needs to be measurable. And in that sense, it needs to be always linked to a goal, something you want to achieve, which otherwise would have not happened. And if we now go to the next slide, I will try to make it a little bit more clearer, or if possible, in a concrete example. Yeah? If we're looking at a transformative development in a certain kind of sub-market, which is maybe lagging some elements which are important, like educational infrastructure, which has high unemployment rates, and other issues, you tackle along those sustainable goals that we have mapped up here, your goals that you want to achieve. Yeah, and is it about urban regeneration? Is it about affordable housing and mixed use and infrastructure that support the community, or as well regarding employment? And you can tackle those on different levels. Yeah, it actually doesn't only is limited to what you build. Yeah, like social housing. It starts as well with the process, how you do your development. Simple questions like, if you're doing your tender process, what of criteria are you applying? Are you applying a criteria which says, I want to instruct a company that actually has a high percentage of workers from the community? Can you enforce on the one that are involved in the project that they reach out to the community and creating job on the development you do? What is with mentally and physically challenged people? Are you able to include companies that support that in their tender process? So just by already defining who works on the project, who will be your development partners, your construction companies, and setting certain targets, you already can start creating an impact. It's not only what you build long term, but it's as well what you build. So then going on and looking at time as well to the next slide, please. Here you can see, as Tanya already alluded, how you have to break it down. Yeah, as it's one thing, it's important. Impact investing needs to have the intention of impact investing. I think it's very important that we differentiate ourselves from certain kind of window dressing approach. Yeah, you're doing a project, and then later on you pride yourself of having done an impact or positive thing just because you've built social housing, which was unavoidable to build because it was a necessity defined by the planning authorities. So it goes beyond that, yeah. And if you break it then down, you start with your goals, yeah. For example, quality places for all. Then you go in about how we address those goals, yeah, like housing, affordable housing in excess of what needs to be done, or on a side where there's actually no need to do it. A transformative development, which includes elements like school, kindergarten, other kinds of infrastructures that you want to have in that neighborhood, as well meeting places for different generations. And then, and I think that's the important aspect, is what we measure. So we have then to define what are we going to measure. Financial metrics, that's simple. Development outputs, which can be done with specialist advisors already. Energy, water, waste, carbon emissions, but as well something like tenant needs and feedback. Sometimes I talk with people and saying, look, this sounds all complicated. Yeah, we cannot measure this. We have no tools to do it. And I say, look, Rome hasn't been built in a day. Why are we making things so complicated? Then why don't we invent tools ourselves? Yeah, we instruct someone to develop an interview, yeah? And we go and ask the tenants. We go and ask people in the neighborhood. And in addition to that, you can use all kind of metrics data that are there. There are social economic data that can be measured. There are numbers on unemployment rate. There are numbers on school education and degrees. And this is the one point about impact investing I try to remind everyone. You have to live with the risk of failing, of not being able to show an impact. That's a key component, because we are at the starting phase. We're pioneering here. And then, you come to the outcome we expect and which we want to show. So I think that's about this slide. And if we can go to the next one, please. And there's a little bit of a summary. Yeah, there's no impact return without a clear definition of the goal. So you have to define your goals at the beginning. And the sustainable development goals are a good starting point. I don't think you have to invent them. You have to then break it down to your fund or to your project. Then we have already various quantitative and qualitative methods to measure impact investing. And I've tried to give you some examples. There are already companies that help you in doing this, that can help you measuring and analyzing your investment. And if this doesn't exist, then a qualitative method is already a good starting point. What is missing, and that's the point, is a defined quantitative metric. And this is one of our key goals, I think, in impact investing in general. I would like to transform this into one a number, which is a kind of impact investing return, just like the financial return. We're not there yet, but this is one of the goals, because I think if I can go to investors and say, look, the financial return of this has been X, like 5%, 6%, but in addition, we had an impact return of 2%, then this is something which can be easily explained, measured, and then impact investing will have the impact that we need, so that it's not a niche anymore, but becomes something that will have to be included in every investment going forward. And I think I would like to conclude with this, for the moment. Thanks a lot.
Okay, also thank you very much, Sebastiano. I like how you said that we have to live with the risk of failing, which is true, which is correct for anything that we do, anything that's new. Although that may be challenging, of course, when you and Tanya, when you seek a return to be able to pay for pensions, insurances, and everything that matters to all of us. Also liked how you said that measurement is key here. And third and final, what you said at the end about having a financial return and an impact return, and also making sure that that impact return is measurable and defendable. I think that's a very good comment that I've certainly taken away. So thank you as well for your contribution. So now we move on. As the saying goes, last but certainly not least, Suzanne. Suzanne, your introductory slide says impact. As far as I'm concerned, this could actually be about yourself and the impact that you've been having on the ESG discussion, both in Germany and beyond, and also how you're helping RICS in advancing this. But let's focus now on ESG and the impact it can and needs to have. We've heard the two previous speakers, let's say, place ESG before impact investment, making ESG a precondition for that. But please explain to us in your words what we mean, what you mean with ESG, where it currently stands, and where the opportunities lie.
Thank you, Sander. So when it comes to the market perspective, it's the most interesting for lots of investors, and that's why I take this impact scheme with some money notes on the back. But let's go to the first slide. When it comes to impact, we cannot ignore the market perspective. Are you also surprised at the force with which the sustainability discussion is being conducted? Not only green, but also social changes are moving center stage. No wonder the pandemic is a huge driver of changes. So what will it mean for the markets? More and more investors are asking themselves what impact the pandemic will leave behind, what changes in the behavior of society can be expected. At least it's about redirecting capital into impact investments with a focus on ESG. So we are facing a huge transformation. 2021 will be the year of transition, not only in Europe, but all over the world. So we have no time to lose. We can start shaping our future if no unexpected catastrophes occur, and we could start to build back better. But what kind of world will it be? What will be important? What will not? What regulation will shape us, and how the next generation will invest? I think there's no doubt we have to contribute. Real estate shapes our life, work, and experience, as we already heard, and it's time that our actions and investments create sustainable impact and support change. But we have to look on a big, broader picture. The next slide, please. So if it comes to the value chain, let's look a little real estate in construction. So in the middle of everything, buildings are currently at the center, whether green, social, or well-being. But if you look at the value chain, it starts earlier. So it starts with active land policies, e.g. if cities looking for new neighborhoods or urban areas, what money they want to have for the land they give. Who describes today what effect this is supposed to have? Who verifies the expected effects? Who find investors who want to achieve impact? So actually, from my point of view, it's not overall, but mostly it's all about money. A lot of money for the land, maybe for the state who sold that land, a lot of money for project development, as much profit maybe as possible, build and goodbye. Do you think we have to do more? I think so. Also, the mindset of sustainability has not yet arrived everywhere. So if you think about the planners which create great wood hybrid constructions to save CO2, but also think about the financiers or maybe valuers which like bricks and mortar, and also think about the insurers, because if you talk about wood, yeah, they think about fire protection in their premiums, and the list goes on. So just think about the circular economy, in which balance sheet are raw materials already shown today, or an impact return, as we heard it from Sebastiano, when it comes to define the profit. So you see here a lot of words under these three pictures. I think we have to start with the value chain much earlier, and we have to define it until the end. And the end is not the exit of a project, it's the reuse of materials. And there's another theme which is interesting on the next slide. I think it's the same with the ESG or the green governance. We have this law from the Green Deal. We know sustainable finance, but when it comes to tax laws, to building laws, to energy law, maybe accounting law, you can see that there are some big gaps. It will take some time to cover all aspects of the Green Deal in several laws and in accounting and reporting. And what about tax? Yeah, so the CO2 tax has just started to punish CO2 emissions. But what about tax incentives when investing in sustainable buildings or financing the renovation wave or building projects with impact? So we have to think a little bit bigger on that theme. But perhaps it would be sufficient for a start if a CO2 balance sheet had to be submitted with a building application, or if a sustainability check were carried out on the materials used, or if during the construction phase the noise level were massively reduced through modular construction and everything was put together much more efficiently and quicker. Here we still need many innovations and upskilling at the operational, but also at the governance level. Let's move to the next slide and look at the increasing demand. So this is the market perspective. Do you not also have the feeling with the many announcements that is massively increasing? Look at the figures from an analysis by Schroders of 650 institutional investors from many countries. So impact investing plus 34% out of the blue. I think there is a mind change, and maybe they would like to look on real estate, but there is no real estate product or construction reference at the moment. So where to invest? I think we have to act on that. And you can see the potential on the next slide. This is also an analysis about the growth opportunities. And if you look at this in institutional investor preferences, so 77% intend to stop purchasing non-ESG products within the next 2 years. So what will it mean? These numbers would make me nervous about offering only non-ESG or say it clear no promise funds. So this is an interesting view, and also you can see here that greenwashing on the right side is one of the big risks the investors look at, and they are concerned about greenwashing due to the lack of clear agreed definitions on what sustainable investment is. So we have to work on this measurement. And let me also look on the SDGs on the next slide. So we have seen the principal reporting standard take the ESG, takes the SDGs and build an investment map, an investment market map. So where to invest and where is it good for? On the other hand, you can see, and I like this look on True Value Labs in the middle, so you can see what is the mostly driven in all aspects you can analyze. Yeah. So the world needs a clear governance for sustainability. So all those gaps I have addressed before are critical, and we have to have in mind that we need here a very clear governance. And it's coming also diverse when you see what investors want or what they like to invest in, which kind of sustainable funds they like. So a lot of interest in that. So for conclusion, on the last slide, I see that the markets of tomorrow will focus more on ESG, will focus more on sustainability and also on impact. So we are all looking for new chances, new products, more focus, better climate. And I want to say help the industry in real estate and construction to rethink and reshape the future. Create this foundation for impact investment, let others participate, do something for good, and surround yourself with those who want to build back better. Thank you, Sander.
Thank you, Suzanne. That was a great overview on ESG and its potential. I apologize to people like Jeremy, Timothy, Michael, John, and a few others for not being able to go into your comments and questions as we've run out of time. But we will try to take them into account in the post-webinar wrap-up. And in any case, thank you for your engagement and posing them. I learned a lot today, and there is no doubt in my mind that both ESG and impact in investment, whichever words we give to them and where they're placed, are necessary and timely concepts to ensure that we continue to develop, evolve, and prosper, and to ensure that we do this beyond the social foundation and within the ecological ceiling. For this, we may need to look beyond economic metrics such as GDP and find additional ways to report on ESG and impact investment and how it benefits shareholders, stakeholders, and the public. I think Sebastiano put it well, that next to the financial return, we may need to include a separate and so-called impact return, which requires thinking it through, setting up the right metrics, making them measurable in a consistent way around the world, which in turn leads to consistent reporting. And when we have this reporting, and I will quote Tina next, we may have the wallet indeed as that powerful means to instigate change. I think Tanya made clear to me that pioneers are already instigating the change, and Suzanne clearly showed figures that things could change even more very quickly and that it could become mainstream, as she said, with 77% intending to stop purchasing non-ESG products within the next 24 months. I use the word measurement a lot, and of course I should, working for RICS. I will say we should not overthink it, as we could be in danger of focusing too much on getting the theory right without making the fundamental change as it happens and as it needs to happen. However, we should also not ignore this challenging question of consistent measurement, but rather include it from the start and learn and adapt as we move forward. All standard and measurement tools that we have now start simple and are based on current knowledge, and they evolve. As was said by the panel, also on one of Tina's slides, we all have a role to play here and we need to work together. So I welcome anybody who attended this webinar to send us their thoughts, comments, and suggestions post-webinar. So again, thank you to the panel and thank you all for listening in, which brings us nearly to the end of this webinar. If you enjoyed it and if you would like to know more about the trends, opportunities, and challenges facing the built environment, or if you'd like to join the discussion with your own opinion and work and thoughts, we would love for you to join the World Built Environment Forum community. As I said, it is a year-long round online discussion platform which you can join, but every year we also get together for a global event, with the next one, COVID permitting, of course, taking place in Dubai in January next year to go inside with the World Expo 2020. I know most of us, certainly me, all of us probably, we're all look forward by now to some brighter times when it comes to meeting with people and traveling around the world. And this may just be the good occasion to do that for you and meet people with similar interests. Next to webinars and our Global Summit, we also have an excellent series of podcasts. With continued working from home, of course, we're all advised to take regular breaks, get away from our desks, have walks in a nearby forest or park. So why not do that and stimulate your mind at the same time as you stimulate your body while you listen to these. If you would like any more information on this and more on what the World Built Environment Forum has to offer, I would also invite you to download the WBEF app from the App Store or Google Play. And with that said, it concludes our webinar. So thank you for listening. Please just stay on for half a minute longer for the single survey question on how you found the past hour, and perhaps also in the box give us your suggestions on which topic you would like to hear about from us next. I thank you all and I look forward to having you join us next time.